Hey, thanks everybody for joining. We've got a great presentation for you today, and we're very excited to have everybody here. We're going to be walking through an overview of the build-to-rent market before diving into the financing, underwriting, asset management, and property management for BFR properties. We've already received a bunch of questions that we hope to address, hope to be able to address most of them in the presentation. But if we miss something, we'll have some time at the very end for questions through the Zoom chat feature. Presenting all of this information is a lineup of great experts. We're just going to go through everybody very quickly with short introductions. I'm Cliff Carnes, Chief Production Officer at Walker & Dunlop for our Capital Markets Group and our BFR SF Group. I'm going to hand it over to Dennis next.
Hi, I'm Dennis McGill, Co-Founder and Director of Research at Zelman & Associates.
Hi, I'm Shannon Persker, Director in the Capital Markets Group. We do debt for all asset classes with a focus on build-to-rent.
Hi, I'm Heather McClure, Director of Capital Markets with a focus in structured finance.
Good afternoon. I'm Andrew Dalglish, and I'm the Chief Underwriter for Walker & Dunlop's agency lending platform.
I'm John Collins, Senior Vice President responsible for GSE asset management for Walker & Dunlop.
Hello, everyone. I'm Scott Bede with Progress Residential.
Before I hand it over to Scott for a for a market overview, I want to stress and emphasize how we're defining BFR for the purpose of this presentation. We are talking primarily about single-family homes, home communities created for the sole purpose of being rented out. These are not properties built for sale and then turned into rentals down the road. With that said, I'm going to go back to Dennis.
Thank you, Cliff. Appreciate it, and thank you, everybody, for joining us. In my section, I'd like to provide a brief background of our firm and then detail high-level fundamental dynamics identified in our research. Zelman & Associates is the leading housing research firm focused across all demand verticals, including home building, apartments, and single-family rentals. W&D acquired a majority interest in our firm earlier this year, and we're very excited to be part of the organization. Our single-family rental research emerged in 2011 alongside our expanded demographic work in a thematic report titled Leasing the American Dream for Now. Our monthly single-family rental survey of property managers and owners, which tracks numerous industry fundamentals, was started later that year, giving us over a decade of data and making us a front-runner in analyzing the sector. We also published several early positive thematic reports on the sector, including The New Old Thing in 2013, which spoke to the fact that the industry was already established in simply attracting institutional interest, and History Repeated in 2016, which took a detailed look at the history of multifamily institutionalization that paralleled many aspects of early stages of single-family rental evolution from the foreclosure crisis. Next slide, please. Before we discuss trends since the pandemic, it's important to put the pre-pandemic fundamentals into perspective. According to our single-family rental survey, blended rent growth averaged 4.1% from 2017 to 2019, as shown on this exhibit. This compares to 3.2% for multifamily, according to our comparable apartment survey. As you can also see, single-family rentals outperformed in every quarter. The sector has also outperformed in each quarter since the onset of the pandemic, with the gap widest in the fourth quarter of 2020. Average single-family blended rent growth over the last 4 quarters has been a remarkable 6.3%, or 1.5 times the pre-pandemic trend. Next slide, please. Although blended rent growth of 8.2% for multifamily in 3Q21 nearly matched single-family rental at 8.6%, this does not capture the cumulative effect since the pandemic started. On this exhibit, we index our 2 data sets to 4Q19. Single-family rents are up 9% since then, and almost 2% higher than the pre-pandemic trend. Conversely, even with the more recent surge in multifamily new lease rates, blended rents are only 3% higher than in 4Q19 and are actually 2% lower than the pre-pandemic trend, obviously with substantial variation depending on the urban and suburban mix. Next slide, please. Turning to occupancy, on a seasonally adjusted basis, 3Q21 single-family occupancy registered 98.0%, a new record for our data and up a robust 210 basis points from 3Q19, as shown on this exhibit by comparing the light blue bar to the dark blue bar. In comparison, multifamily occupancy was at 96.5%, not as healthy as single-family rentals, but still the best in recent history. However, we note that for both sectors, economic difficulties and eviction moratoriums have led to elevated bad debt expense. Adjusting for the increase in bad debt expense, shown here in the brown bars, occupancy figures would moderate. The single-family sector would still be higher than in 3Q19, but multifamily would not. This is something to keep in mind as eviction moratoriums end, various government stimulus programs fade, and supply accelerates. Next slide, please. In September of this year, we published another thematic report detailing the exploding institutional investor interest in single-family built-for-rent projects. We believe that our firm is in a unique position to triangulate the emerging trends, given our substantial relationships with home builders and land development organizations. Based on our tracking, we've identified more than $75 billion of institutional capital for build-for-rent projects, with the vast majority announced in the last 12 months, and it's seemingly growing by the day. Going forward, we will be continuously updating our database, marrying the information with our home building and multifamily development analyses to have the truest picture of supply. I would now like to turn the presentation over to Heather.
Thanks, Dennis. That's some great information. We can go on to the next slide. For the next 7 minutes, Shannon Hersker and I will discuss inflection points along the development timeline, some consistent with traditional multifamily and some unique to BFR. We'll go from land development to disposition in our 7 minutes allotted. We go on to the next slide. As you know, the development process starts with land identification, zoning, and entitlements. But this is a unique inflection point for BFR. Does the developer buy raw land, entitled land, or finished lots? Additional decisions include single plat horizontal multifamily or individually platted lots. There's pros and cons to both of these strategies, including impacts to the cost of actual development, for impact fees, amount of taxes when stabilized, and the flexibility of disposition. That's a whole nother webinar, unfortunately. In addition to traditional land development entitlement, a distinguishing characteristic of some BFR strategies, especially those focused on single-family detached homes, entails the acquisition of finished lots from lot developers with a focus of then programming and developing the vertical component, the homes themselves. At the land stage, pre-development dollars are generally funded by equity, and even more specifically funded by GP capital, while LP investors typically prefer to come into the deal once it's fully entitled and ready to pull permits. Generally, as long as the deal is owned, there's co-GP capital available to assist with pre-development dollars, especially if there's a pipeline. We can move on to the next slide. We recently closed a co-GP investment for a client, or arranged a co-GP investment for a client, providing capital for their project level pre-development dollars and enabling them to more rapidly execute and expand upon their existing pipeline. I will not get into the specifics of pricing and structure due to confidentiality, but also because there's so many variables that influence the deal. Variables include when those pre-development dollars come in, how much credit support the GP is going to, or partner is going to provide, the ability to, how much land is in the pipeline, how much back office support, and then, but there also another benefit of having that co-GP partner is a more efficient LP capital oftentimes. And in exchange for this, developers will share a portion of their development fees and share in the promote with their co-GP partner. At this point, I'll turn it over to Shannon to further discuss capital structure.
You can go to the next slide. So as we've been discussing, the build-for-rent market continues to grow. Our build-for-rent internal group receives a tremendous number of inbound calls every single week for both debt and equity, and that's everyone from multifamily developers, single-family home builders, landowners, and general contractors. We're currently working on build-for-rent in over 30 states, with the majority of what we're seeing in the Southeast, Texas, and Southwest. So when Heather and I work together, we typically start actively marketing the debt once the equity has been circled. On our last webcast, we talked about how there was a huge need for more construction lenders to enter this space. Since then, we've really seen several new groups become comfortable with the product. We're seeing banks get more aggressive on on pricing and leverage, where banks would lend at, say, 60% 6 months ago, 6% loan to cost. We're now seeing up to 65% loan to cost at 4%, and that's non-recourse. Most of our clients do want non-recourse. However, if you are comfortable with a portion of recourse where, some of it will burn off throughout the stages of construction and lease up, banks will go up to 75% loan to cost at about 3.25% rate. And for larger deals, say above 30 million, the debt funds will go up to 80 to 85% of cost. Now, as long as the metrics work on the takeout. We're actually doing a deal right now in Salt Lake City, and that's at 80% loan to cost, and that rate's at 5.25%. You can go to the next slide. So our debt and equity teams partner to develop the most efficient capital structure, both in terms of pricing and alignment strategy. We're currently working on a deal right now. It's a luxury build-for-rent deal with an exceptionally experienced sponsor. And we were able to get to 85% loan to cost with a senior and a pref piece on top. And that pref is full accrual. And in this instance, the sponsor chose to go this direction as opposed to common equity because they knew they wanted to build a long-term cash flowing portfolio. And on this deal, once it's fully stabilized, Walker & Dunlop will refinance into a permanent loan. You can go to the next slide. So as developers consider their next step, the capital event, they have to decide on a hold versus sell analysis. And for the hold component, we would look at a permanent loan. Walker & Dunlop is one of the leading agency lenders in the country, so we know this space really well. As Keaton Merrill, my business partner, likes to say, we like to work backwards. When we look at a deal, we really want to make sure that it would work for Fannie and Freddie before we even take it to a construction or a bridge lender, because not every deal will work. The agencies will look at a deal once it's 90% occupied for 90 days, and typically we're seeing the agencies lend up to 75% loan to value at about a 130 coverage and a 330 rate. We did a deal in Nashville that was 74% loan to value, and that was a 10-year term with 3 years of IO, followed by 30-year amortization, and that rate was 311. Now, that was at a 90 treasury, so that rate today would probably be about 3.25 to 350. Additionally, life insurance companies are getting into the space, just at a lower leverage than the agencies at this point. But overall, looking at permanent financing, it's very much like a multifamily loan, especially as the agencies are more comfortable with underwriting and the overall product. And next, we'd want to consider whether the equity needs to be recapitalized to monetize the promote. And I'll hand it back to you, Heather.
Thanks, Shannon. So wrapping up the whole analysis, developers need to look at whether or not they want to stay and crystallize the promote with their existing equity if that equity is willing, or if there's a need to recapitalize the equity with new long-term equity. Moving on to the sell analysis, for BFR, developers should start considering their hold sell options early, sometimes before they even break ground. There are numerous disposition of options available, some of which are unique to BFR. Like traditional multifamily, developers can choose to pursue a merchant builder path where they build, lease, and stabilize the asset prior to disposition, or they can choose to sell earlier. Many developers are now opting to sell at certificate of occupancy. Selling at certificate of occupancy allows developers to reduce or eliminate lease-up cost, as well as minimize additional market exposure. If individually platted lots, then they can deliver and monetize those profits even faster, provided that the construction loan is negotiated with release prices and they are able to release them as soon as they finish with the vertical component. Additionally, on the other side of the trade, purchasing at CO gives buyers an opportunity to manage the lease-up. An interesting corollary of this certificate of occupancy model is a hybrid development joint venture in which some large institutional owners are opting to provide development equity as a means to get control of the end product with a pre-negotiated buyout price. Interestingly, we're starting to see an option for developers to sell even earlier. We're seeing an increasing interest in pre-sales in select markets, and again, I need a caveat, in select markets, allowing the developer to lock in a sales price before the first foundation is poured. As developers evaluate each sell option, they weigh the risk of optimizing sales price in the future market with future rent growth with the risk of market movement and delay in monetization of the profits. So speaking of selling at CO, Shannon and her team are active on the other side of that trade.
Yeah, so Walker & Dunlop actually finances the other side of that transaction, which is the buyer's certificate of occupancy financing. Builders are building on their construction line, and our sponsors are taking down the units as they're delivered at certificate of occupancy. This is a really popular model right now, and the lenders love it because they're not taking construction risk, they're just taking lease-up risk. When you compare this to a traditional multifamily project, it's especially attractive because the units are delivered in manageable tranches and they're easier to lease up. In this instance, the sponsor is really able to manage their rent rolls and when they push rents. And I can tell you that every deal that we've worked on, we've beaten our pro forma rents by as little as 3% to as much as 26%. And for the bridge at C of O, banks will lend at 65% loan to cost non-recourse at 3.25%, where debt funds will go up to 80% loan to cost, and those rates will vary.
In summary, our clients participate in every part of the development process. Many are going from raw land to completed homes, but a portion are also purchasing finished lots and programming the unit mix. W&D is constantly monitoring the capital markets and advising our clients on the most efficient, effective capital structure and disposition strategy. As a final note, we recently advised on a platform level investment for a client who historically has acted as a merchant builder, but now has decided that they'd like to have the flexibility to hold long term after their initial pipeline is developed. And so we have helped them identify that capital. Now I'll turn it over to Andrew in our underwriting group.
Thank you, Shannon and Heather. For the next few minutes, I will discuss our underwriting considerations for build-for-rent properties in general and agency underwriting guidance in particular. We can move to the next slide. Underwriting for build-for-rent assets tracks very closely with the traditional multifamily properties, with a few notable exceptions. All in all, there are more similarities than differences when comparing the underwriting for build-for-rent assets with traditional multifamily. Both Fannie and Freddie are active in this space, and the underwriting for both agencies is similar in nature. Freddie has a strong interest in this asset type, and Fannie Mae delegates the underwriting for build-for-rent properties directly to the DUS lender with no requirement for pre-review. So let's begin by looking at the similarities. We treat the underwritten income projections the same as we would as a traditional multifamily transaction. The GPR will be based on the current rent roll, and the NRI will be determined based on the most current collections. Typically, we're looking at a trailing 1 or a trailing 3-month analysis and a minimum vacancy factor of 5%. Similar to NRI, other income projections are also based on the actual collections with appropriate support from historical trends. The sources of other income that you see in build-for-rent are very similar to what you see in traditional multifamily and include RUBS, pet rent, application income, late fees, and other miscellaneous income items. There are some typical multifamily sources of additional income that are not as prevalent in the build-for-rent space. Examples include parking, laundry, and commercial income. While we do not run into these items as often due to the inherent asset design of build-for-rent, we would project the income from these items in a similar nature to what we do for a traditional multifamily transaction. On the expense side, many of the underwriting expenses also track very closely with that of multifamily. Utility costs are analyzed on historical trends, and insurance will be based on a verified premium. Management fee will be based on the actual contract, and advertising and administrative costs will be based on the historical operations with adjustments for any one-time expenses. When we analyze payroll expense for build-for-rent assets, we use similar strategies that we would for traditional multifamily. We'll look at the historical trends, analyze the current payroll schedules, and review the budgeted staffing needs. However, payroll costs for build-for-rent can vary widely in terms of staffing levels that are needed for properties that are in lease-up compared with what is needed for properties that have achieved stabilized operations. Scott will touch on this later in the presentation, but it serves as a good segue to the differences between underwriting and build-for-rent versus multifamily. In terms of the differences, turnover is an interesting expense line item for build-for-rent. The turnover ratios tend to be significantly lower than that of traditional apartments, but the turnover costs tend to be higher as the larger unit common areas lead to greater expense for painting and flooring replacements. The increased turnover costs almost offset some of the operational savings that you would expect from the lower turnover rates. Similarly, the larger unit sizes, lower density, and lack of shared walls impacts R&M and landscaping, and oftentimes real estate taxes. While these costs can tend higher, it exposes one of the difficulties that we face in underwriting build-for-rent assets. This is a relatively new asset type, and we do not have the availability of detailed third-party comparable expense data that we do for traditional multifamily. As such, we tend to treat the underwriting for these expenses similar to what we would do for traditional multifamily by relying heavily on the historical operations of the property. As for the taxes, we'll verify with actual tax bills, which can often be more difficult than BFR, as some jurisdictions will assess each home site individually. While the relative newness of the asset type and lack of robust third-party comparable data cause some challenges for our underwriting professionals, the strong rental demand and favorable treatment from the agency allows for opportunities and strengths in our underwriting. Build-for-rent properties typically have higher rents than traditional multifamily, in conjunction with per-unit expenses that are similar to and oftentimes lower than that of traditional apartments. This results in favorable expense ratios. Additionally, the build-for-rent assets that we are seeing as of recently tend to be recently stabilized or newer assets. The low expense ratios and newer property condition really help us lean into interest-only terms for our build-for-rent assets. Finally, the agencies do not treat the sizing of build-for-rent any differently than they would traditional multifamily. There are no punitive adjustments for DSCR or LTV, meaning the same minimum debt service coverage ratio and maximum loan to value that you get with a traditional multifamily property is also available for build-for-rent assets. So as you can see, the underwriting for build-for-rent is really very similar to what you see for traditional multifamily projects. And now I'll pass it along to John Collins to discuss our asset management group's views on build-for-rent.
Thanks, Andrew. Andrew just brought you through the underwriting process. Servicing asset management really picks up from there and after the loan is closed, there are similar thematic elements between the asset management and the underwriting process and how we view things. Sorry, next slide. In terms of the servicing asset management for a loan secured by a build-for-rent property, overall it is pretty similar to a traditional multifamily loan. Payments, no difference here at all. Borrowers make their payments and we collect them. Tax and insurance impounds. Similarly, we typically collect funds in order to make payment for real estate taxes and ensure that the property has appropriate insurance and that the insurance payment is made. Servicer consents. As with a multifamily loan, we are responsible for managing the loan document requirements, and a build-for-rent property would have the same sorts of requirements as a traditional multifamily. As servicer, we need to consent to a number of different events. These would typically include condemnations or takings, easements, property management company changes, and transfers of interest within the borrower ownership and the like. Operating statement analysis. No different than with any other property type, we will collect quarterly and annual operating statements, which we code and spread and send analysis to the loan investor. As Andrew mentioned, the income and expense line items are really no different than with a traditional multifamily. Inspection protocols. Again, the requirements for inspections are no different as most properties are inspected every year or every other year. Thank you. All of these similarities and consistency with traditional multifamily does not mean that there are not any nuances. Typically, loans require the borrower to fund a monthly deposit to reserve for replacement that is held by the lender, and these funds are made available to reimburse the borrower for certain items of a capital nature. One thing that is different for build-for-rent properties, in part due to many being new construction, but also due to the level of finish of the property, is we will see an allowance for the use of the replacement reserve for items such as central vacuums and exterior power washing, which is not typical for traditional multifamily. I mentioned earlier that we will impound for taxes and insurance. This too may be a little different than most multifamily loans, as there is a greater likelihood of multiple tax parcels, and given the lower density, there is likely a larger expanse of land and or building count, which may result in additional insurance considerations, such as varied parts of the property being in or out of flood zones. Lastly, while the inspection protocol is pretty much the same, the forms are a bit different that we use for a build-for-rent property, and the cost that the servicer takes is a bit higher for us to perform or contract out for these inspections because of that greater land area and the building count. So with that, I will hand it over to Scott. Thank you.
Thank you, John. So for those of you who may not be familiar with Progress Residential, we entered the single-family rental space in 2012. We currently manage 72,000 homes across 29 markets. We actually manage for both our parent company, which is Preddy and Partners, but we also manage for fee for other institutional investors. While most of our portfolio is scattered, about 2 years ago, we did get into the build for rent space, dedicated rental community space. We currently manage 44 build for rent communities, but we have 62 additional communities in our pipeline, which will start delivering in 2022. Next slide, please. With regard to the definition of build for rent versus the for sale product converted to rentals, the reality is that most of the product that has been delivered to the marketplace thus far is truly for sale product that has been converted. While we have many build for rent, purpose-built communities in the pipeline for 2022, there have been very few that have actually delivered to date that were planned rental communities. With regards to variables in the build for rent dedicated communities, the detached versus townhouse product is certainly a variable. Community size, we have seen mostly around 100 homes in the detached and townhouse communities, and we're seeing very light amenities in these build for rent communities. Next slide, please. With regard to similarities, certainly townhouse communities favor and are more similar to the multifamily side versus the detached product. With regard to lease-ups are very similar to multifamily, while stabilized operations tend to be very different in SFR dedicated communities. On the marketing front, again, very similar to multifamily during lease-up, but in stabilized world have much less turnover, much less marketing needs. With regard to common area maintenance, as mentioned previously, most communities are very light on amenities, so common area maintenance generally does not include some of your heavier amenities that are seen in multifamily, clubhouses, fitness centers, swimming pools even. Next slide, please. With regard to the differences, resident profile is very different in SFR and especially in detached SFR. We're seeing millennials forming families. We're seeing middle-aged families with school-aged children coming to this SFR space. And that is a very different resident profile than what we see in multifamily typically. What are they coming for? They're basically coming for private backyards and attached garages and lower density. Again, family formation, existing families looking for private space that they really can't get in multifamily. They, from a amenity standpoint, they're really not as particular as multifamily renters. They're looking for, again, more space and those backyards and garages, but they are not necessarily into the common amenities that you would see in multifamily. As mentioned previously, turnover is significantly less in both dedicated rental communities, SFR in general. We see about a 30% less turnover in this space, and that basically is about half of what you would see in multifamily. So stabilization looks very different in some of these communities because of the lower turnover and because of the lack of need for maintaining amenities. So what we see is basically communities that are less than 170 homes don't need an on-site maintenance staff, don't need an on-site leasing staff after they stabilize. A couple of the things that we do see in the space is that residents are preferring smart rent technology. They're very keen on that type of technology because of their family makeup. And so that is one area that they're looking for. So community management really at the end of the day, after they're stabilized, is more like managing an HOA, managing common areas, managing violations, that type of thing. Leasing is, because of the low turnover, is certainly less central than multifamily. And with that, I will turn it back over to Cliff. Thank you.
Sorry about that. Hey, that was great, everybody. Thank you very much. That was fantastic. I see we've got some questions coming in and we've got some time left. So Kate, do you want to read some of those questions for us and see if we can't get them answered?
Yep, we had a few sent in before the webcast and a few coming in through chat. So if you want to keep sending those in, we'll see what we can get to. Starting off with, I think, Dennis and Scott. Should BFR operators look into buying a home builder? Are BFR operators willing to build homes on their balance sheets?
Yeah, I can start off on that. I think it's very likely that you're going to see continued combinations between traditional home builders and single-family build-for-rent operators. You're already seeing some of the largest home builders like Lennar, D.R. Horton start internal divisions specifically focused on single-family rental. I think most of the largest public builders are affiliated in some way with a build-for-rent platform, either discrete partnerships or selling individual homes. And it just makes sense from our perspective that you'll continue to see the single-family sector merge together from the for sale and for rent side, much like you have seen on the multifamily side over time. And some companies will be more focused on the development side. Some will be more focused on the management side. An interesting spin on that question as well would be whether we see a single-family operator and a multifamily operator get together over time. We think that's very likely as well, just given some of the similarities in the attached product, particularly in the suburbs. Scott, anything you want to add to that?
Dennis, no, I agree with everything you said. We are seeing some glimpses of multifamily developers looking to get into the single-family development space, and so I concur with your thoughts.
Great. I think this next question is for Scott as well. Should BFR communities have on-site property management?
I think that's twofold. One, during lease-up, I would say yes, mostly to manage the site, manage construction, manage the curb appeal, and thus during lease-up. After lease-up and stabilization, it's really all about the size of the community. Again, we see communities above about 170 homes. We feel like there's enough turnover and enough common areas and so on. Obviously, if there's going to be amenities, it'll be on these larger communities. So I would say 170 homes or greater right now is where we see kind of the cutoff point for maintaining an on-site staff. Below 170 homes in stabilized world, we should be able to manage without having on-site staff. Again, depending upon the management company, but in our case, we have capabilities of roaming fleets, vehicles, service, and do leasing through self-showing and so on. Thanks, Kate.
Thank you. We've had a couple questions coming in on cap rates. I think, Heather, this goes to you. Are cap rates on BFR product different than traditional apartments?
12 months ago, I would have said that the cap rates were a little bit higher on BFR, but we are seeing them converge now. And interestingly, because a lot of the rents are higher, I mean, your overall per unit valuation can be higher than that of the traditional multifamily. So we're seeing cap rates about the same right now.
Great. Shannon, can you discuss single parcel versus all individually parceled BFR projects?
Yeah, so we actually get this question a lot, but I think it's a misconception that, that people have, but the agencies, they don't care between multi-parcel and single plat. They'll finance both. In fact, the deal I mentioned that we did in Nashville, that was actually 34 individual lots, and that was a Fannie deal. But I think also, and Heather maybe will speak to this more too, but equity actually prefers multiple parcels because it gives them alternative exit strategies. I don't know if Heather, you want to add to that?
I would say, I mean, there are some equity groups that really have a strong preference towards individually platted lots, but then there's probably an equal number that like the horizontal multifamily strategy. And, you know, there's pros and cons. We are not tax experts at all, but, you know, everything that we're hearing, you know, we're from other panels and discussing it with tax consultants, you know, they are seeing that it's harder to protest your taxes on an individually platted lot because the tax authorities are looking at for sale homes and where those are valued versus if you're on a single plat horizontal multi, you can argue that you should be valued up against, you know, or assessed at the same rate as multifamily. So, you know, your taxes in an individually platted lot can be higher, your impact fees can be higher, but then like Shannon said, your options on the back end can be better as well in terms of if you decide that you wanted to break it up at some point. So it just gives you additional optionality. So there's definitely pros and cons to both. And, you know, there's some municipalities that have strong preferences one way or the other. So it really just depends on the land.
And I think it's important to add just for the agencies, as long as it's purpose-built for rent, contiguous lots that really looks and feels like its own community, that's what they look for.
Great. We've got a lot of questions coming in. Maybe Heather, can you please weigh in how the returns compare between traditional apartments, 3-story surface parking versus BFR, given the high land and construction costs for BFR?
Well, so my partner always says land is the plug, right? And so that's why you're not going to see a large BFR community in the middle of downtown Dallas. You're going to be in the suburbs and the exurbs. That said, even with the additional land requirements, your returns are comparable. And part of that is, like I said, because you're getting higher rents. I mean, we have specific examples where across the street a build for rent deal is getting significantly higher rents than their multifamily competitor. Now, how long that lasts, we're not going to hazard a guess. That said, I mean, the demand is certainly there for the build for rent product. And so you're able to get higher rents. Occasionally you're able, depending on the structure, you may be able to operate it slightly more efficiently. So your overall return parameters are going to be about the same.
Great. Underwriting question, how do replacement reserves used for underwriting of BFR compare to multifamily?
Yeah, I can take a swing at this. It's interesting because we are seeing most of these assets that are newer properties. So you're sort of in the first generation of a lot of this, so you don't have a lot of the larger items, big ticket items that would drive up your replacement reserve showing up right now. In the future, though, you're not going to get the efficiencies of scale or the economies of scale that you would for a traditional multifamily because you do have 4 exterior walls on every home, you have a different roof on every home, and you have more common areas within the units. So currently, they track fairly similar to traditional multifamily. I have a feeling that when you look at it in the future, you're going to see in sort of the second or third generation of these assets cycling through as they become 10 and 20 years older, you're going to see significantly higher replacement reserves in the future than you do right now.
Great. Next question, please discuss liquidity and valuation of denser SFR product, for example, horizontal apartments. IVNH and AMH seem to solely be focused on detached. Who buys denser? Is it multifamily buyers or SFR operators?
I can go ahead and answer that, Kate. I'll say that you do have some single family, you know, buyers that are coming in to buy, but you also, for the horizontal multi, you attract both the single family buyers as well as multifamily buyers. And so, I mean, it's housing. And then they're all looking at it as if, you know, it's not that different to operate. I mean, you get somebody who's an expert like Scott to come in, but certainly, I mean, your liquidity is good regardless of which option you decide to go.
And to follow up on that, probably Andrew, should you underwrite expected multifamily rent growth or SFR rent growth for these?
That's a very interesting one to look at. If you can get the data that shows single-family rental growth, you really want to compare these on single-family rental growth than you would to a traditional multifamily property. And I think Dennis has a lot of the information on that and is able to provide a lot of what that looks like for the future. But if we're going to underwrite it, we're going to underwrite it based on the best available information, and that would be comparing with other single-family rental.
I have to say, Andrew, that warms my my broker heart. Certainly, I mean, it is important to look at the single family competition and look at those growth rates.
Also for Andrew, what is an expected expense ratio minus the property taxes for the properties when trying to underwrite?
And I saw this one, and I don't have that data right in front of me, but from sort of a rule of thumb, on really older multifamily properties, you can see the expense ratios starting to trip up over 50%, which really impacts the IO you can get on a property. Traditional newer multifamily is typically in the 40 to 50% sort of area. And then you see some newer multifamily going down below that 40% into the 30s. And with this single family rental, depending on the stabilized operations and the historical data you have, you can see that getting down in the 30s and below on some of the transactions. And then there was one other question I saw that came down later, which was the minimum size for the agencies. And what you'd run into here is typically you're going to want to see a built community that looks like a community and feels like a community. But there is no separate guidelines from Fannie Mae in terms of what the build for rent is. It is still the same as multifamily, so it is 5 units and above.
Great. This one was one that was submitted earlier and kind of in this feed as well, and probably for Dennis. How big is the market today? How big should it be? And is this a fad or not?
So I assume we're talking strictly around build for rent. The way that we would think about it is we start first with thinking about the needs for single-family construction and multifamily construction coming out of our demographic work on just how to think about household formation and housing demand. So when we think about sizing the build for rent market, we would look at that in conjunction with home building, traditional for-sale home building, and think about single-family as a percentage of the overall and whether it's demographic factors or age factors are going as far as preference for single family versus multifamily, and then take that down a level and think about own versus rent. So I think it's a little bit difficult to scale build for rent particularly because I think that's going to have to come out of what had been traditionally home building, since that's where all the new construction was being done. And similar to multifamily, it's probably going to be cyclical. There's going to be points in time where there's a lot of new construction brought to market, and there'll be points in time where it's not needed, and you'll see that pull back a bit as well. But we do see the single-family side, much like multifamily, is that there's going to be an ongoing rental component. There's going to be companies that are very focused on development. I think you've got more institutional capital doing that today, but I think we always have to go back to some of the work we were doing back in 2013, is that the single-family rental market has always existed. And there's rental homes across the entire country that you can use to understand rent growth and compare comps the same way you would on a multifamily new development, and recognizing you're going to have some premiums for new construction and then have to adjust for location. But there is plenty of data out there. I think it's just different in that the involvement today is much more institutionalized.
Thank you. Another question. What are you seeing as the largest hurdle in regards to taxes once the homes are completed and bought? I know we don't have tax experts on today, so maybe that would be the follow-up.
I mean, I will say, and probably Scott can answer this better, but on a recent panel, a Ryan tax expert had said that, really on the individually platted single-family detached, what they find the most difficult is being able to, try to minimize that assessed value, because you're having to look at the home values in the neighborhood or in adjacent neighborhoods, and that's typically higher than your comparable multifamily unit. So, on the single plat, horizontal multi, they're able to look to those other multifamily properties on the assessed value, and rightly so, right? Because it is truly multifamily.
Question, I think, for Scott. Thoughts on on-site property management?
Thoughts on on-site property management? Is
Yes.
that what the question is? Minimal during lease up. Again, size of community demands whether or not you need it after stabilization. Very different than multifamily in the sense that you typically do not need a maintenance staff, a leasing staff, an office, a management staff on site on community, again, less than 170 homes when it's stabilized. But you have to have the right management company that has the platform to do that. You have to have fleet vehicles to be able to go and service the home. You have to have self-showing technology for leasing. You have to have customer care, remote call in, and that type of thing. So it is very different than multifamily management after stabilization.
And regarding townhomes for rent, what is more important, a master on the main first floor or a garage?
I'll say a garage. The single family renters coming for a fenced backyard or private backyard and a garage space. It's about their lifestyle. They have families. They don't necessarily want to park the car in the garage, but they want to put their stand-up paddle boards, their kayaks, their bicycles, and everything else in the garage. They want the backyard space so they can have a pet outside without putting it on a leash, and they want to be able to have barbecues or put the kids out in a fenced backyard. That's typically what we see.
Great. What valuations are you seeing for stabilized sale at C of O and negotiated sale before completion?
I would say the sale at C of O is not that different from what we're seeing in terms of the sale, once leased up, because I think that buyers are seeing the benefit of being able to manage their own destiny and able to manage the rent roll. The sale, kind of the pre-sale, certainly there's a discount, and it's just a matter of whether or not that discount makes sense to the developer on whether or not they're willing to take it.
All right. We have another underwriting question. Can you please add more color on turnover ratios and how should costs reserves for turnover costs be sized?
And I might rely on Scott for some of this, but what we were looking at in our portfolio in general is oftentimes your turnover ratios for traditional multifamily can be upwards of 50 to 60%. What Scott is seeing in his portfolio, and Scott, you can correct me if I'm wrong, but you're closer to 30% in what you're seeing, correct?
Correct.
So the 30% is you get a good benefit from that 30%, but I think also when you look at those turnover costs, the turnover costs are probably about 30 to 40% higher. And between the two of those, it really eats away at some of the cost savings that you would think you would encounter because of the low turnover ratios.
Great. As a follow-up to that, could you address the differences in underwriting / performance between BFR and SFR, scattered sites, example, invitation homes?
And so what I'll say at the moment is because we are looking at build for rent on this webcast today, the single family rental is a completely different animal and would take an entire different webcast to go over. So today we're just going to focus on the build for rent for Fannie and Freddie. And one other item that came up along those lines that I saw in the questions was a idea if there's a townhouse style plat versus a single family plat, how would the agencies treat that? As long as it is all build for rent housing, Fannie Mae will dedicate the underwriting of that to us as the DUS lender, as long as no other guide waivers are required. So as long as they haven't sold off individual homes and they're not working on a site that has single family homes and multifamily, then we can do the underwriting of the both the townhouse style and the single family units, and if there's a multifamily portion of it, all under the same loan and same delegation.
Great. Next question. With on-site leasing only present during lease-up, how is leasing and tenant interaction with property management handled post-stabilization?
Leasing is handled remotely, typically with self-showing technology, smart home technology, and a national leasing center type approach. And what was the other part of the question, Kate?
It was
Interaction.
Sorry, dismissed it too quickly. I apologize.
All right. I think it was interaction with the residents and interaction with our residents is done through our own call center, our customer care center that we man, and customers, our residents reach us directly, via resident portal or via phone, either way.
Is the development timeline generally quicker or slower compared to traditional garden product?
I can speak to that. We think that it's quicker, right? I mean, after the actual physical construction takes less time to build a single family home versus if you're in a garden multifamily where you have multiple stories and stairs and access and entry points. And then I would say, what was the question? Forgive me one more time. I was like,
the development timeline is
generally
quicker or slower.
I had 2 points. There's one on the actual construction, but then also the lease up typically takes a shorter amount of time for the BFR because they're able to deliver units kind of on a rolling basis versus in a traditional multifamily, maybe you're going to get a chunkier delivery of units. So that way you're kind of, maybe you get 30 or 40 and you lease 20 a month. Well, on the single family, you're getting 15 to 20 max. And so you're able to lease them as you deliver them oftentimes. At least historically, that's what we've seen so far.
Do the agencies have a minimum unit size project for financing?
Yeah, and I think I covered that earlier, that as far as the agencies are concerned, they want to see properties that are actual communities, but it would fall under their charter guidelines, which is a minimum for multifamily of 5 units.
Do individually platted lots lead to higher taxes and reevaluations?
And I think we answered that earlier, that oftentimes they can lead to higher taxes. And it's just a matter of hiring a really, qualified tax consultant.
Great. If a buyer has to close in multiple phases upon C of O, how do you foresee the debt financing? Some lenders may have issues with closing in phases or not having control of the HOA.
Shannon, I think that's a good one for you to answer because I know that y'all have done quite a few of those types of deals. And I know Keaton really digs into that whole HOA.
Yeah, so I didn't hear the first part of it, but I did see another question too, with the types of burn off through construction. And that, it really varies per deal, but typically, we just did a deal, for example, where the recourse was 50% at the close of the loan, and then it burned off to 25% at C of O, and then it goes away, at a given debt yield or occupancy. And then I didn't hear can you repeat the other part of the question?
Yep. Some lenders may have issues with closing in phases or not having control of the HOA. So if a buyer has to close in multiple phases upon C of O, how do you foresee the debt financing? Some lenders have issues with
so the financing would be about 65 to 80% loan to cost. And as far as the HOA, that is very important. We would definitely need to understand how the HOA looks and then, we would have to be the declarant and control the HOA. So that's something that we talk to all of our developers up front to make sure that we have that.
Well, and I know that the lenders typically are looking, we're going out to lenders who are willing to fund in tranches, and that's kind of part of the deal, and the expertise that Shannon and her team are bringing to the table is that ability to structure those funded tranches versus needing everything funded at one time.
Yeah, they're comfortable with
I think for Scott, what maintenance functions do residents typically perform inside and outside of the home?
Yeah, that's a good question. I think we generally see the SFR renter as a more DIY mentality. They're looking for the homeownership experience, if you will, and they're not as locked in on concierge type services or maintenance, if you will, that a multifamily renter is. So they are willing to do more of their own repairs. We've specifically written our lease different. We don't use a multifamily lease. We put more responsibility on the resident for this fact, and they accept it. Typically, they are, from an interior maintenance perspective, basically anything that they cause, like a clogged drain or something. If they cause it, they're typically responsible for it. On exterior maintenance in built for rent communities, which is what we're talking about today, we see typically that the owner or management company is taking care of the landscape maintenance and basically billing residents back for that. It becomes an ancillary income line item for these communities. That is a much better way, in this setting than having the resident or the renter provide their own landscape maintenance. In scattered home portfolios, many times the resident has to maintain the lawn because it's not feasible. But that is one of the advantages of build for rent communities, allowing for some other ancillary income items and things like landscape maintenance to be done, by the owner.
And then I think we just have time for one more. How is the appraisal process with SFR? Do you value each home separately?
With SFR, it depends on the SFR deal, but most of the lenders, at least so far, are asking for each deal to be valued separately. And so it's it is a somewhat cumbersome process. We're working with a number of those lenders to come up with a kind of a more efficient, effective process. But so far right now, kind of the most competitive ones are asking for individual valuations.
Great. And with that, I will turn it back over to Cliff to wrap us up.
Perfect. Thanks, Kate. That was great. Unfortunately, we are out of time today, as Kate said. But I do want to give special thanks to all of our presenters. That was fantastic. I hope everybody found this very useful and helpful. Hopefully all of you know Walker & Dunlop is the #1 multifamily lender in the country, and we were a leader in the BFR SFR space before the industry took notice. Currently, we have $4.6 billion in our BFR SFR pipeline, and we are absolutely perfectly positioned to service all of your financing and transaction needs. We had lots of questions today, and unfortunately, we couldn't get to all of them. But if you want to reach out to us, you can at bfrsfr@walkerdunlop.com. And before I forget, I also want to mention Dennis and his great research. More of that can be found at Zelman, Z-E-L-M-A-N, associates.com, or you can reach out to info@zelmanassociates.com. I'd like to thank everybody for the time today and have an awesome rest of the week. Thanks, everybody.